Let me pose a question that most investors never seriously consider. If you could only own four stocks for the next 10 years, no trading, no adjustments, no ability to react to news or market movements, just four companies that you would hold through whatever comes, what would you choose? This is not a hypothetical exercise for me. I think about this question constantly because it forces a level of clarity and conviction that most investment decisions do not require. When you can trade freely, when you can adjust your portfolio in response to every earnings report and economic indicator, you can afford to be somewhat casual about your holdings. You can tell yourself that if something changes, you will react. But when you are locked in for a decade, when you have to live with your decisions through recessions and booms, through technological disruptions and competitive shifts, through management changes and regulatory upheavals, you cannot afford to be casual. You have to choose businesses with such overwhelming competitive advantages, such exceptional management, such durable growth prospects, that you can be confident they will be worth substantially more in 10 years, regardless of what happens in between. This question has become even more important to me as I have gotten older and thought more carefully about wealth preservation and transfer across generations. The strategies that work for generating returns over months or quarters are very different from the strategies that work over decades. Short-term success often comes from being nimble, from reacting quickly to information, from trading around positions. Long-term success comes from identifying truly exceptional businesses and having the patience and conviction to hold them through inevitable periods of volatility and uncertainty. These are fundamentally different skills, and the long-term skill is far more valuable for building lasting wealth after more than 30 years of analyzing businesses, investing across every sector and geography, competing against the smartest investors in the world, and watching companies rise and fall. I have developed a very clear view of what separates truly exceptional businesses from merely good ones. And today, I am going to share the four stocks I would choose if I had to commit for the next decade. These are not speculative bets on emerging technologies or turnaround stories where everything has to go right. These are dominant franchises with competitive moats so wide that I would be comfortable owning them through any conceivable economic environment. They are companies I would trust with my family's wealth, knowing I could not touch it for 10 years. Let me explain not just which companies I would choose, but why I would choose them. Because understanding the reasoning is more valuable than knowing the names. The framework I am about to share will help you evaluate any business for long-term ownership. Before I reveal my four choices, let me explain the framework I use to identify businesses worthy of decade-long commitment. This framework has been refined over decades of experience and has proven remarkably reliable at identifying businesses that compound value over long periods. The first criterion is competitive advantage that is sustainable over long periods. Many companies have advantages today that will erode over the coming years. Technology changes, consumer preferences shift, new competitors emerge with better products or lower costs. Regulations evolve in ways that help some companies and hurt others. The businesses I want to own have advantages that are self-reinforcing, that actually get stronger over time rather than weaker. These might be network effects where each additional user makes the product more valuable for all other users, creating a virtuous cycle that becomes nearly impossible to break. They might be scale advantages where size creates cost efficiencies that smaller competitors cannot match no matter how hard they try. They might be brand advantages built over decades of consistent quality and marketing that create customer loyalty resistant to competitive attacks. They might be switching costs that make it painful and risky for customers to leave, even if alternatives emerge. Whatever the source, I want advantages that compound rather than decay. I want businesses that will be more dominant in 10 years than they are today. The second criterion is management quality and alignment with shareholders. Over a decade, management will make thousands of decisions that I cannot see or influence. They will allocate billions of dollars of capital, to acquisitions, research and development, marketing, infrastructure, and share repurchases. They will navigate competitive challenges that we cannot anticipate today. They will pursue growth opportunities that do not yet exist. They will set the culture and hire the people who will determine the company's trajectory long after current management is gone. I need to trust that these decisions will be made with shareholders' long-term interests in mind, rather than short-term metrics or personal empire building. This means I look for managers with significant personal stakes in the business, whose wealth rises and falls with the stock price. Just like mine. I look for track records of intelligent capital allocation, of avoiding overpriced acquisitions that destroy value, of returning excess capital when attractive reinvestment opportunities are not available. I look for honest communication with shareholders, for transparency about challenges as well as opportunities, for willingness to admit mistakes and change course when necessary. Finding managers who check all these boxes is rare, which is why my list of decade-worthy companies is so short. The third criterion is a large and growing addressable market. A company can have the best competitive position in the world, but if its market is shrinking, returns will be limited. I want businesses operating in markets that will be larger in 10 years than they are today, driven by secular trends rather than cyclical factors, demographics, technological adoption, emerging market growth, regulatory changes. These are the forces that drive multi-decade market expansion. The best businesses are positioned to capture disproportionate share of growing markets, compounding their advantages as they scale. The fourth criterion is financial strength and capital efficiency. I want businesses that generate substantial free cash flow, that do not require constant external financing to fund their operations, that can weather economic downturns without distress. I want businesses that earn high returns on invested capital, that create value when they reinvest profits rather than destroying it. Financial strength provides optionality. It allows management to be opportunistic during crises, acquiring distressed competitors, or investing aggressively when others are retrenching. The first stock I would own for the next decade is the dominant company in cloud computing infrastructure. This business has built something extraordinary, a global network of data centers that provides computing power, storage, and services to millions of customers ranging from startups to the largest enterprises in the world. The competitive position is formidable. The company has invested hundreds of billions of dollars building this infrastructure over more than 15 years. The scale advantages are immense. Each additional customer reduces the average cost of serving all customers. The data generated by millions of workloads improves the machine learning models that power the services. The developer ecosystem built around the platform creates switching costs that make it painful for customers to leave. Think about what it would take for a competitor to challenge this position. They would need to spend hundreds of billions of dollars building data centers around the world. They would need to develop the software stack that makes the infrastructure usable. They would need to build the developer tools and documentation. They would need to establish the reputation for reliability and security that enterprise customers demand. They would need to recruit the engineering talent to maintain and improve everything, and they would need to do all of this while the incumbent continues investing and innovating. The barriers to entry are essentially insurmountable for new entrants. The only real competition comes from two other hyperscale cloud providers who made similar investments years ago. And even among these three, this company maintains a significant lead in market share and breadth of services. The growth runway is enormous. Cloud computing is still in the relatively early stages of adoption. Most enterprise workloads still run on legacy on-premise infrastructure. The migration to the cloud will continue for decades as companies recognize the advantages of flexibility, scalability, and access to advanced services like artificial intelligence and machine learning. The pandemic accelerated digital transformation, but it also revealed how much further companies have to go. The total addressable market for cloud infrastructure and services, is measured in trillions of dollars, and this company is positioned to capture a substantial share. The financial performance reflects the quality of the business. The cloud division generates operating margins well above 20% and growing as scale effects compound. The free cash flow generation is extraordinary, providing resources for continued investment and returns to shareholders. Management has demonstrated discipline in capital allocation, investing heavily when opportunities are attractive, while also returning capital through buybacks. The valuation is reasonable relative to the growth trajectory and the quality of the business. This is exactly the kind of investment I want for a decade-long holding period. Let me elaborate on why the cloud opportunity is so large and durable. Think about what enterprises used to do before cloud computing existed. They would buy servers, install them in data centers, hire people to maintain them, manage security and updates, plan for capacity that might be needed years in the future. This was expensive, inflexible, and often resulted in either too much capacity sitting idle or too little capacity, constraining growth. Cloud computing changes all of that. Enterprises pay only for what they use. They can scale up instantly when demand increases and scale down when it decreases. They get access to sophisticated services like machine learning and analytics that would be impossibly expensive to build themselves. They benefit from security investments that exceed what any individual company could afford. The value proposition is overwhelming, which is why adoption has been growing at such rapid rates. But here is the remarkable thing. We are still in the early innings of this transition. Most enterprise workloads, probably 70 or 80%, still run on traditional on-premise infrastructure. The migration to cloud will continue for at least another decade, probably two. And as enterprises move more of their operations to cloud, they become more dependent on the platform, more likely to use additional services. More valuable as customers. The revenue from an enterprise customer typically grows substantially in the years after initial adoption as they expand their usage and adopt new services. This land and expand dynamic means that growth comes not just from new customers, but from increasing value per customer over time. The artificial intelligence opportunity adds another dimension to the growth trajectory. Training and running AI models requires enormous computing resources. The cloud providers are the natural home for this workload because they have the scale, the specialized hardware, and the software tools that AI development requires. As AI adoption accelerates across the economy, it will drive substantial incremental demand for cloud infrastructure. This company is particularly well positioned given its early investments in AI-specific hardware and services. The second stock I would own for the next decade is the dominant company in digital advertising. This business has built the most valuable advertising platform in history by aggregating the attention of billions of people and providing advertisers with unprecedented ability to target their messages to receptive audiences. The competitive advantages are extraordinary. The company operates multiple platforms that collectively reach more than 3 billion people daily. The data generated by these users, their interests, behaviors, connections, and preferences allows for advertising targeting that no other medium can match. When you advertise on television or in print, you are broadcasting to a broad audience and hoping some of them are interested. When you advertise on this platform, you can reach exactly the people most likely to be interested in your product, dramatically improving return on advertising spend. The network effects are powerful and self-reinforcing. Users come to the platforms because their friends and family are there, because that is where content is shared, because that is where communities form. Advertisers come because the users are there. The advertising revenue funds continued investment in the platform, which attracts more users, which attracts more advertisers. This flywheel has been spinning for nearly 2 decades and shows no signs of slowing. The business has demonstrated remarkable resilience through multiple challenges: privacy changes, regulatory scrutiny, competitive threats from new platforms, shifts in user behavior, none of these have meaningfully dented the company's dominance or profitability. Management has navigated these challenges skillfully, adapting the business model while maintaining the core advertising franchise. The investment in artificial intelligence is transforming the business in ways that most investors do not yet appreciate. The company is using AI to improve advertising targeting, to automate campaign optimization, to generate creative assets, to enhance content recommendation, to improve safety and security. These investments are increasing the value proposition for advertisers while reducing costs, expanding margins, even as the business continues to grow. The AI capabilities being developed will have applications far beyond advertising, creating optionality for future growth. The emerging market opportunity is particularly exciting. Billions of people in developing countries are coming online for the first time, predominantly through mobile devices. These users are joining the platforms and will become increasingly valuable to advertisers as their economies grow and their purchasing power increases. The company is already the dominant social media and messaging platform in most of these markets, positioning it to capture this growth as it materializes. The financial performance is exceptional, operating margins consistently above 30%. Enormous free cash flow generation that funds both aggressive investment and substantial capital returns. A pristine balance sheet with more cash than debt. Management that has created enormous value over the company's history and is aligned with shareholders through significant equity ownership. The valuation has become remarkably attractive following a period of investor skepticism, offering a rare opportunity to buy one of the best businesses in the world at a reasonable price. I want to spend more time on why digital advertising is such a durable franchise, because I think many investors underestimate its resilience. Some people believe that advertising is vulnerable to technological disruption, that consumers will find ways to avoid ads, that privacy regulations will undermine targeting capabilities. I have studied these concerns carefully, and I believe they misunderstand the fundamental nature of the business. Advertising exists because businesses need to reach customers, and customers need to discover products and services that meet their needs. This is not going away. The specific mechanisms of advertising evolve, from print to radio to television to digital, but the fundamental economic function persists. Digital advertising has proven remarkably adaptable to challenges. When privacy regulations limited certain types of tracking, the company invested in new targeting technologies that maintain effectiveness while respecting privacy. When customers complained about intrusive ad formats, the company developed less disruptive approaches that maintain engagement. When competitors emerged with different content formats, the company adapted by adding similar capabilities. The history of this business is one of continuous adaptation to changing conditions while maintaining the core value proposition for advertisers. The regulatory concerns are real but manageable. Yes, there is scrutiny from governments around the world. Yes, there may be restrictions on certain practices, but the fundamental business of connecting advertisers with consumers is not going to be regulated out of existence. Governments recognize that advertising funds the free services that billions of people rely on. Any regulations that were too restrictive would have consequences that policymakers are not prepared to accept. The most likely outcome is continued adaptation and evolution rather than existential threat. The third stock I would own for the next decade is the dominant company in enterprise software. This business provides mission-critical applications that run the operations of the largest companies in the world. Customer relationship management, enterprise resource planning, human capital management, supply chain management, financial planning. If you are a Fortune 500 company, you almost certainly use this company's software somewhere in your operations. The competitive position is extraordinarily defensible. Enterprise software is deeply integrated into business processes. It connects to other systems. Employees are trained on it. Workflows are built around it. The data residing in these systems is essential to operations. Switching to an alternative would require massive investment in implementation, training, and process redesign. Most companies simply do not switch unless they have compelling reasons, and usually not even then. The business model has evolved in ways that make it even more attractive for long-term ownership. The shift to cloud delivery has transformed lumpy license revenue into predictable subscription revenue. Customers now pay monthly or annual fees that recur automatically, providing visibility into future cash flows. The subscription model also allows for continuous product improvement, with updates delivered seamlessly rather than requiring painful upgrade projects. Customer lifetime values have increased substantially as relationships extend and expand over time. The growth algorithm is powerful and sustainable. Start with a massive installed base of enterprise customers. Expand within those customers by selling additional modules and applications. Increase prices annually because switching costs make customers price insensitive. Acquire complementary software companies to extend the platform. Use the data from millions of enterprise users to build AI capabilities that make the products even more valuable. This algorithm can drive double-digit growth for many years, even in a mature market. The artificial intelligence opportunity is potentially transformative. The company is embedding AI capabilities throughout its product suite, enabling automation, prediction, and optimization that were previously impossible. A sales representative can get AI-generated recommendations for which prospects to prioritize. A supply chain manager can get AI-powered forecasting of demand fluctuations. A finance team can get AI-assisted anomaly detection for fraud prevention. These capabilities increase the value of the software, support continued price increases, and deepen competitive moats by making the products even harder to replace. Management has executed brilliantly over a long period. They have navigated the transition from on-premise to cloud successfully. It's destroyed many legacy software companies who could not adapt. They have maintained pricing discipline while investing for growth. They have made strategic acquisitions that extended the platform without destroying value through overpayment. They have returned substantial capital to shareholders while still investing for the future. The track record inspires confidence that they will continue making good decisions over the next decade. The valuation is reasonable for a business of this quality and durability. One of the aspects I find most compelling about enterprise software is the predictability of the revenue streams. Unlike consumer businesses where customer preferences can shift rapidly, enterprise software relationships are measured in years and decades. A large company that implements a major software system is not going to rip it out on a whim. The costs of switching are enormous, the risks are substantial, and the benefits of staying with a proven vendor are clear. This creates an annuity-like quality to the revenue that is incredibly valuable for long-term investors. You can project with reasonable confidence what the business will look like in 5 or 10 years because the customer relationships are so stable and the expansion opportunities within accounts are so predictable. The competitive dynamics also favor incumbents in ways that are not immediately obvious. When an enterprise is evaluating software vendors, they care deeply about the vendor's viability and commitment to the market. They want to know that the vendor will be around in 10 years, that they will continue investing in the product, that they will provide support and updates. Large, established vendors have inherent advantages in this evaluation because they have the resources and track record that provide confidence. Smaller competitors, even if they have innovative products, often cannot win enterprise deals because customers perceive them as too risky. This dynamic protects the incumbent's market position and allows them to compete on factors other than just having the best product. Fourth stock I would own for the next decade is the dominant company in semiconductor manufacturing equipment. This business provides the tools that chip makers use to manufacture the most advanced semiconductors in the world. Every smartphone processor, every AI chip, every advanced memory device is manufactured using equipment from a small number of suppliers. And this company leads in several critical segments. The competitive position borders on monopoly in certain categories. The equipment required to manufacture leading-edge semiconductors is so complex, so precise, so difficult to build that only a handful of companies in the world can do it. In the most critical areas like lithography and deposition, there are effectively one or two suppliers serving the entire global industry. Customers have no alternative but to buy from these suppliers, providing extraordinary pricing power and margin stability. The barriers to entry are essentially absolute. The technology has been developed over decades of cumulative research and development investment totaling tens of billions of dollars. The manufacturing know-how is embodied in processes that cannot be easily replicated. The customer relationships and application knowledge have been built over long periods of collaborative development. A new entrant would need to make impossibly large investments with no certainty of success against established competitors who would continue advancing during any catch-up period. This is not an industry where disruption is possible. The secular growth drivers are powerful and durable. Semiconductor demand is driven by digitization, which continues across every sector of the economy. Artificial intelligence requires massive amounts of computing power, driving demand for more and more advanced chips. Autonomous vehicles will require sophisticated semiconductor content. The Internet of Things is embedding chips into billions of devices. Data centers are expanding to meet insatiable demand for cloud computing and storage. Electric vehicles require far more semiconductor content than internal combustion vehicles. Every one of these trends drives demand for more semiconductors, which drives demand for more manufacturing equipment. The geopolitical dimension adds another growth catalyst. Governments around the world have recognized that semiconductor manufacturing capability is strategically essential. The United States, Europe, Japan, and others are investing hundreds of billions of dollars to build domestic chip manufacturing capacity. Every new fab that gets built requires billions of dollars of equipment from this company and its peers. This government-funded expansion will drive growth for years beyond what normal commercial demand would support. The financial performance reflects the quality of the business. Gross margins consistently above 40% due to the lack of meaningful competition. Operating margins in the high 20s or low 30s that have proven durable across cycles. Substantial free cash flow generation that funds both research and development investment and capital returns. Management has demonstrated disciplined capital allocation, avoiding the temptation to diversify into lower-quality businesses or make overpriced acquisitions. They understand their competitive advantages and invest relentlessly to extend them. The cyclicality that has historically characterized the semiconductor equipment industry has moderated significantly in recent years. The diverse end-market demand from smartphones, data centers, automotive, industrial, and consumer electronics creates more balanced growth than the concentrated demand of previous eras. The shift to more complex chip designs means that each new generation of semiconductors requires more equipment investment than the last, creating structural growth on top of cyclical demand. And the government subsidies driving capacity expansion in multiple regions are providing a demand floor that reduces cyclical risk. I also want to emphasize the irreplaceable nature of these businesses. There is no alternative to the equipment this company provides. If you want to manufacture advanced semiconductors, you must buy from a small number of suppliers who have spent decades developing the required capabilities. This is not a situation where a competitor can emerge with a better approach. The physics of semiconductor manufacturing imposes constraints that favor the established approaches. The knowledge is embodied in organizations and processes that cannot be replicated. This creates a permanence to the competitive position that is rare in any industry. Now let me explain why these four businesses together form an ideal portfolio for the next decade. They are diversified across different end markets and growth drivers, reducing dependence on any single trend. Cloud computing growth is driven by enterprise digital transformation. Digital advertising growth is driven by consumer attention and e-commerce. Enterprise software growth is driven by business process automation. Semiconductor equipment growth is driven by chip manufacturing expansion. These are related but distinct trends that will not all move in the same direction at the same time. They share common characteristics that make them exceptional long-term holdings. All four have dominant competitive positions with sustainable advantages. All four have management teams with strong track records and shareholder alignment. All four are growing faster than the economy with long runways remaining. All four generate substantial free cash flow that can fund investment and returns. All four have reasonable valuations relative to their growth and quality together. They represent the best thinking about what businesses will be most valuable over the coming decade. Let me address potential risks because every investment has them. Technology changes could theoretically disrupt any of these businesses, though I believe their positions are more durable than most. Regulation could impose constraints, particularly on the digital advertising company, which faces ongoing scrutiny. Geopolitical conflict could disrupt semiconductor supply chains, though the equipment company would likely benefit from reshoring efforts. Valuation multiples could compress, even if business fundamentals remain strong. A severe recession could temporarily slow growth across all four companies. I acknowledge these risks, but believe they are more than compensated by the quality of the businesses and the prospects for long-term value creation. The key insight is that these risks apply to any investment. No portfolio is risk-free. The question is whether you are being adequately compensated for the risks you are taking. With these four businesses, I believe you are getting exceptional quality at reasonable prices with long runways for growth. That is the definition of a good investment. Some investors might look at this portfolio and observe that it is concentrated in technology. That is true in a narrow sense, but I would push back on the characterization. Yes, these companies are classified as technology, but they are really infrastructure businesses that happen to use technology. Cloud computing is infrastructure for the digital economy as essential as electricity or telecommunications. Digital advertising is infrastructure for commerce, the mechanism by which businesses reach customers. Enterprise software is infrastructure for business operations, the systems that run companies. Semiconductor equipment is infrastructure for hardware manufacturing, enabling the physical products that power everything else. These are not speculative technology bets. They are ownership stakes in essential infrastructure that will be more valuable as the economy grows and digitizes. The concentration also reflects the reality that the best investments often cluster in sectors experiencing secular growth driven by fundamental changes in how the economy works. In the 19th century, the best investments were in railroads and industrial companies, enabling the physical transformation of America. In the 20th century, the best investments shifted to consumer companies and financial services as the economy matured and consumption became the driver. In the 21st century, the best investments are in the digital infrastructure that is transforming every sector. Ignoring this reality in the name of traditional diversification would mean owning inferior businesses simply to check boxes. I want to address how individual investors might think about applying these ideas. You do not need to limit yourself to 4 stocks. You have the flexibility to own more positions to adjust over time, to respond to changing circumstances. But the exercise of identifying businesses worthy of decade-long commitment is valuable, regardless of how many stocks you actually own. It forces you to think about quality and durability rather than near-term catalysts and trading opportunities. It focuses your attention on competitive advantages and management quality rather than quarterly earnings beats and misses. It encourages patience rather than activity. Too many investors destroy value through excessive trading. They buy and sell based on noise rather than signal. They react to headlines and price movements rather than focusing on business fundamentals. They incur transaction costs and tax consequences that compound against them over time. The mentality of choosing businesses you would commit to for a decade, even if you do not actually commit for that long, is an antidote to these destructive behaviors. The 4 businesses I have described represent my highest conviction ideas for the coming decade. They are not the only good investments available in the market today. There are many other excellent companies I would be happy to own and have owned over my career. But if I had to choose just 4, if I had to concentrate my entire net worth in businesses I could not touch for 10 years, regardless of what happened in markets or the economy, these are the 4 I would choose with complete confidence. They have the competitive positions, the management quality, the growth prospects, and the financial strength to compound value through whatever the next decade brings. That is what great investing looks like. Not predicting the future, but owning businesses so good that you do not need to predict the future. Not timing the market, but owning businesses whose value will grow regardless of market conditions. Not trading actively, but owning businesses you trust enough to hold through volatility and uncertainty. These principles have guided my investing career. They have built substantial wealth over decades, and they will continue to work for as long as capitalism exists and quality businesses compound value for their owners. The specific stocks I choose may change over time as circumstances evolve, but the underlying philosophy of identifying exceptional businesses and holding them with conviction will remain constant. That is the foundation of successful long-term investing.